Hey everyone, it's AG back again, and yes, I know you noticed I wasn't here yesterday. Another avatar stepped in for a moment, but the way you all reacted made something very clear. You wanted me back, white shirt and all. Honestly, I'm genuinely touched, because yesterday's story was something straight out of a financial thriller. What unfolded wasn't just unusual, it was historic. 2 days ago, on January 29th, the silver market pulled off what should have been impossible. It blasted its way to a record-shattering 12,246, closing out a 300% surge that triggered pure FOMO among retail investors across the globe. Then, almost instantly, the ground gave way. Silver didn't simply pull back, it imploded. A violent 30% collapse dragged gold down with it, smashing the price from $5,600 to below the $5,000 mark in what analysts are now calling the most brutal liquidation event of the modern era. The media rushed to declare the party over. According to them, a combination of shockwaves and a surging dollar had killed the bull run. They told you this correction was the end of the story. But while everyone was fixated on those falling prices, they completely missed the details that actually matter. They ignored the 8% lease rates spiking in London. They overlooked the 33 million ounces quietly draining out of COMEX vaults. What we witnessed wasn't a collapse. It was a coordinated trap. If you panic and dump your physical metals now, you're essentially gifting your wealth to the same institutions that suddenly found themselves short on liquidity. Today, we're repeeling back the curtain to show you what the headlines are, T willing to touch. The system just slammed headfirst into a zero liquidity wall, and the path to 150 silver is in T speculation. It's a mathematical outcome of the reality we stepped into as 2026 unfolds. Let's talk about the piece almost everyone missed. Price charts grab attention, but behind those numbers is something far more important and far more telling. If you're not someone who lives inside the commodities market every day, let me put that 8% lease rate into perspective. A lease rate is the cost for borrowing physical bullion. Normally, borrowing silver is cheap, practically free, because the system assumes an endless pool of metal sitting safely in vaults worldwide. Typically, you're talking 0.3% to 0.5%. That's the usual range. But when that number suddenly spikes to 8%, you're staring at a gigantic red flag. A lease rate that high screams one thing loudly. Someone is desperately trying to get their hands on physical silver and cannot find enough of it. Nobody pays 8% to borrow something abundant. You pay that when you're cornered. And here's where the story gets even more interesting. Because while silver AS of paper price was in free fall, the real physical market was sending a completely different signal. Dealers across the board were reporting that premiums on physical bars and coins were staying elevated even as futures pricing was collapsing. Retailers couldn't keep 1 kilogram bars on shelves. Mints worldwide were notifying buyers about production delays. It didn't matter that the chart on your phone showed a massive correction. The real-world market wasn't behaving like a crash at all. That gap, the gulf between paper price and physical demand, is something we've seen before. Think back to March 2020. The moment the shutdown panic hit, anyone trying to buy physical gold or silver ran into a nightmare. Premiums blew up to 30%, 40%, and even 50% above spot. Dealers were out of stock. Delivery times shifted from days to weeks, then months. If you called your local shop and asked for silver at spot price, they would practically laugh and hang up. On-screen prices said metals were cheap, but if you wanted to actually buy some, they were either unavailable or insanely expensive. It took weeks for the paper market to catch up, and once it did, prices surged hard to reflect reality. But here's the key difference. The 2020 surge was driven largely by retail buyers panicking during a global outbreak. Everyday Americans were scrambling for safety. What's happening now is coming from institutions, sovereign wealth funds, and central banks, players who do not buy on emotion and do not sell when things calm down. These are long-horizon strategic actors positioning for a monetary realignment. And this time, the disconnect is widening faster. The buyers are bigger, and the consequences go beyond any cycle we've seen before. The silver futures system has always depended on one underlying assumption. Almost nobody will ever ask for actual delivery. It's a casino where everyone plays with chips instead of cash. The game only works as long as no one tries to convert their chips into real money. But what happens when big players, the ones who move markets, decide they want the metal, not the contract? What happens when they want their ounces in their own vaults, not a promise from a New York bank? Let's look at the numbers. Analysts watching the derivatives market estimate that the ratio of paper silver claims to actual metal has blown out to astonishing levels. Some estimates exceed 300 to 1. That means for every ounce of physical silver actually sitting in a vault, there are 300 claims stacked on top of it. It works only as long as almost nobody asks for delivery. But once that number starts rising, even a small fraction, the game becomes unstable. That's what the 33 million ounce withdrawal tells us. That was not noise. That was not seasonal. That was not random. That was strategic buying. When the price is falling and metal disappears from vaults simultaneously, it means someone with deep pockets is preparing for a moment when these paper claims collapse under their own weight. Lease rates confirm the same thing from another angle. When the cost to borrow metal skyrockets, it means lenders fear they might never get it back. They aren't raising rates to make a profit. They're raising them to protect themselves from being left without metal entirely. It's insurance, not greed. But let us address the question you could are probably thinking. If physical demand is this strong, why did the price crash so violently? The answer exposes how detached financial markets are from real-world supply. The price you watch on your screen is not set by some guy buying a silver coin. It is controlled by massive institutions trading absurd amounts of leverage in milliseconds. Algorithms don't care about fundamentals. They care about liquidations. When the dollar surged on the worst nomination, algorithms triggered commodity-wide selling. Silver, because of its smaller market size, took the brunt of it. Leveraged traders were forced to unwind, then more selling, then margin calls, then forced liquidation. It was a domino effect. But here onks the part people overlook. None of the fundamentals that pushed silver to 12,246 disappeared. Solar manufacturers still need silver. EV makers still need silver. Central banks haven't abandoned diversification. The industrial world didn't stop using the metal. All that changed was the paper price, not reality. This was not the end of the bull market. It was the exposure of the system's weakness. What is unfolding right now isn't the collapse of silver. It is the exposure of how fragile the paper system has become. Every correction, every drop, every sudden plunge simply reveals more cracks. And instead of weakening the long-term bullish case, it strengthens it. The more violent these swings become, the more they show the limits of a system stretched beyond what physical supply can support. At the core of this volatility is a straightforward reality. You cannot trade silver like a limitless digital token when the actual metal exists in limited, measurable quantities. And when panic-driven liquidations collide with real-world scarcity, the result is exactly what we witnessed. Drastic. Erratic movement that hides the underlying shortage rather than solving it. This brings us to something the mainstream refuses to talk about: the shift in who is buying. For years, silver's biggest buyers were retail investors reacting emotionally to headlines. That is no longer the case. The entities stepping in right now, the ones draining COMEX vaults, the ones driving lease rates higher, the ones accumulating bars quietly while prices fall, are not weekend traders. These are sovereign wealth funds, central banks, and institutional players. They don't chase trends, they create them. When they step in during a crash, it's not because they got spooked, it's because they see value. And that's what brings us back to the dollar. Nearly every analyst with a microphone has celebrated the recent surge in the dollar index, which jumped after Washington confirmed the Kevin Warsh nomination. The media plastered headlines everywhere. Strong dollar crushes metals, dollar rally ends silver bull, and the usual barrage of simplistic correlations. Sure, the dollar surged. But here's the part they want to say. That rally is artificially inflated by panic positioning, not underlying strength. A currency doesn't suddenly become invincible because of a nomination. What we're seeing is a short-term squeeze, a reflexive uptick driven by futures traders, not fundamentals. And this is where timing becomes critical. A strong dollar is supposed to push gold and silver down. But look at what actually happened. Even with the dollar rallying hard enough to grab global attention, physical silver demand didn't fall. In fact, it spiked. Dealers reported multi-day stretches of record sales. Online platforms were logging multi-hour queues. Something isn't adding up, unless you realize that the spot price is no longer reflecting real-world buying. But the real bombshell came when inside sources reported that multiple banks were scrambling to cover physical shortfalls after the Warsh announcement triggered that massive short squeeze in precious metals. Those institutions didn't suddenly need silver because of sentiment. They needed it because they were caught on the wrong side of the trade. That's why lease rates exploded to 8%, and that's why we saw those sudden 33 million ounces vanish from storage. These were not random coincidences. That was panic accumulation at the highest level, the kind investors never hear about until after the fact. This is where the bigger picture starts to crystallize. For years, analysts have warned that the paper silver market was a balloon stretched far too thin, but those warnings were ignored. Why? Because prices stayed relatively stable. That stability created the illusion that the system could handle infinite leverage. But when institutional buyers start demanding delivery, real, physical, measurable silver, the illusion dissolves instantly. And that's exactly where we are right now. Let's step back and look at the timeline. The question experts are quietly asking behind closed doors is this: How many more of these shocks can the system absorb before something breaks? Because remember, this isn't happening in isolation. We're in the middle of a global economic realignment. The BRICS expansion, the ongoing shift toward non-dollar trade settlements, the resurgence of commodity-backed mechanisms. The world is changing. Nations are diversifying reserves. Central banks are increasing metals exposure. And for the first time in decades, silver is becoming a strategic asset, not just an industrial metal. But let us talk about something that almost nobody's discussing: the massive regulatory firestorm that erupted recently. The moment the dollar surged and metals plunged, the entire situation reached Washington faster than expected. Several sources confirmed that individuals in the financial ecosystem linked to Jerome Powell's circle are now facing criminal investigation. Yes, you heard that correctly. The same name tied to multiple controversial fiscal decisions over the last decade is now connected to sharp, highly questionable movements inside the commodities and currency markets. This isn't conjecture. This is becoming the biggest scandal in decades, and for the first time, it could have direct consequences on how metals are priced in the future. When officials tied to monetary policy are investigated for benefiting from sudden engineered market swings, confidence in the system evaporates. And once confidence collapses, people turn to tangible assets. Historically, when that happens, silver doesn't just go up, it goes vertical. Let's turn to China for a moment, because the numbers emerging from Beijing are mind-blowing. In just a few months, China has quietly accumulated more silver than the US buys in an entire year. They aren't doing this for industrial needs alone. They're preparing for a world where physical commodities, not promises, define power. The country is sitting at the center of a massive pivot, with manufacturing demanding more silver than global mines can supply. And when China wants something, they don't nibble, they buy relentlessly. At the same time, global production is stagnating. Mines are operating at full capacity, yet struggling to meet demand. Meanwhile, solar manufacturing continues to break new records every year. Electric vehicles require more silver per unit than ever before. Electronics consumption isn't slowing down. Medical and technological applications are growing. And with every new factory, every new production line, every new innovation, more silver disappears into non-recoverable uses. Now combine this with the estimated 300-to-1 paper-to-physical ratio. Think about what that means. Imagine 300 people holding a ticket that claims ownership of the same single ounce sitting in a vault. The system works only because most people never try to redeem their ticket. But what happens when even a small percentage tries to claim delivery? We're not talking about retail investors triggering this. We're talking about central banks, institutional giants, and sovereign entities suddenly requiring their allocated silver. That's how a market breaks. And that is why the volatility you've been witnessing is a sign of weakness. It is the early stage of a structural failure. Paper traders are selling promises. Real buyers are taking metal. And every ounce that leaves the vault widens the cracks. Here's what comes next. And this is the part almost nobody is prepared for. At some point, the pressure building inside the system reaches a critical threshold. And when that happens, the paper markets lose their ability to suppress or dictate the price of silver. Once a major institution, or sovereign buyer, or even a cluster of industrial giants demands large-scale delivery and the vaults cannot meet those obligations, the price will no longer be based on leveraged contracts. It will be based on real physical availability. And when price discovery shifts away from digital promises and toward actual bars and actual vaults, you're going to see a price explosion unlike anything in modern financial history. Analysts who study structural imbalances have already calculated what that moment looks like. If the paper-to-physical ratio truly sits near 301, the moment the system breaks, the repricing required to match real supply with real demand is staggering. It's not a matter of $30 silver, it's not 50. It is not even 100. The numbers that show up in those models point toward 150 silver, not as a prediction, but as the clearing price required to restore equilibrium. That's the number that comes up again and again when analysts remove leverage, derivatives, rehypothecation, synthetic instruments, and purely speculative positions from the equation. And here's the most important part. The correction we just experienced didn't fix the imbalance. It widened it. Because while the paper price dropped 30% in a single devastating swing, real-world physical demand didn't cool off for even a moment. Silver kept flowing out of vaults. Lease rates kept climbing. Delivery requests kept increasing. If this were a genuine crash driven by fading interest, everything would have calmed down. But nothing calmed down. Everything accelerated. This is why ignoring mainstream narratives is essential right now. Because the mainstream only sees one thing, the chart. They see a downtrend and think the story is over, but the people who actually understand commodities, who track inventory flows, lease rates, refinery operations, sovereign accumulation, and central bank activity, know that the spot price is the least important metric in moments like this. The price on your screen is telling you what a handful of leveraged traders are doing inside a tightly controlled digital arena. What matters is what happens outside that arena, in the real world, where metal is mined, minted, shipped, and delivered. Let's talk about the geopolitical angle again, because it's impossible to ignore. The ongoing scandal tied to Jerome Powell's circle is more than just an embarrassing headline. It's shaking trust in global markets in a way central banks cannot easily reverse. When the people responsible for stabilizing economic systems are themselves tied to manipulation, backdoor communication, or self-benefiting trades, the entire foundation of monetary credibility fractures. And when trust erodes at the top, nations move to protect themselves. They do that through hard assets, not promises. The timing of this scandal aligns perfectly with the recent surge in the dollar index, the Warsh nomination shock, and the sudden acceleration in physical precious metals buying worldwide. None of this is coincidence. Whenever faith in a currency is threatened, not by inflation or recession, but by systemic corruption, global markets respond instantly. Countries begin shifting reserves. Industrial giants start securing long-term supplies. Sovereign funds look for stability where digital contracts cannot provide it. And whether the media likes it or not, silver is emerging as one of those stability assets. But let's shift our focus back to the industrial sector, because it is one of the biggest pillars holding this market together. The demand curve for silver from solar, electric vehicles, battery technology, electronics, and medical applications is not decreasing. It's surging relentlessly. Every major solar manufacturer is increasing silver consumption year after year. The EV sector continues expanding. The global transition to electrification is not slowing down. Every new chip, every new sensor, every new panel requires physical silver, not paper claims. And once industrial buyers realize there is less available than the market assumed, they will compete more aggressively for what's left. This is where China plays an enormous role again. Their buying is happening at a scale that dwarfs U.S. demand. Not only are they securing industrial supplies, but they are also quietly building reserves. This is long-term positioning, the kind that takes years to unwind. Once China accumulates metal, it doesn't re-enter the market. It's gone permanently. That's why the withdrawal of 33 million ounces from COMEX was such an earthquake. Silver leaving a vault during a correction is the opposite of normal behavior. It's a signal that the largest players are preparing for something big. Now add the fact that mining output is struggling. Global production isn't rising fast enough to meet accelerating demand. Many of the world's largest mines are dealing with declining ore grades, rising costs, and geopolitical complications. New mines take a decade or more to develop. We are not just facing a temporary shortage. We are staring at a long-term supply problem. You cannot create more silver out of thin air. You cannot press a button and print it. Meanwhile, the digital system continues trading contracts at a volume that assumes limitless supply. These opposing forces cannot coexist forever. When the break occurs, it will happen suddenly and violently. One day, everything will function as normal. Prices will fluctuate. Analysts will speculate. Headlines will chatter. And then, out of nowhere, delivery failure will hit the system. It could be a large investment fund demanding allocation. It could be a sovereign nation requesting physical settlement. It could be industrial buyers refusing to rely on the paper market anymore. And the moment that happens, the world will discover that there is not enough silver to satisfy more than a tiny fraction of outstanding claims. That's when the repricing hits. That's when the move toward $150 silver becomes reality. And that's when the people holding physical metal, not promises, not futures contracts, not digital tokens, will suddenly understand why the last few years of volatility were necessary. Every crash, every rally, every surge, every plunge was part of a larger process. The slow, unstoppable exposure of a system built on leverage and denial. If you walked away from the crash because of fear, you stepped out right before the real phase begins. But if you held through it, if you stayed calm while the entire market panicked, you positioned yourself for the moment when price finally reflects truth, not speculation. Because in the end, this isn't a story about charts. It's not about traders. It's not about cycles. It's about reality asserting itself over illusion. And reality is simple. You cannot manipulate scarcity. You cannot fake physical supply. And you cannot print silver. This is just beginning, and the world is not ready for what comes next.